Hello friends, before I begin this video, may I request a few seconds of your time? No, it's not what you think it is, but it's as important. You see, those of you who've been connected with me for long enough have given me a lot of love and affection and have appreciated my work on television interviews, print and electronic media articles, etc. And you know me as a pure prop trader, which I have been doing since 1986. So you see, we focus on doing things, which is why we have zero idea about digital marketing, about advertising, or how to reach our work across to a bigger segment of the audience. But we want to keep our work free. And just because it's free, it doesn't mean it should not reach out to a whole lot of people. Can we depend on you to give us the word of mouth and other push like sharing our work with your social media platforms, with your social media groups, etc., so that we can reach out to a wider audience and spread the virtue of knowledge? If you can do that, it would be absolutely great for us. Now, let's dive right into the video.
Hello, friends. Last week in my video, I basically raised the question whether the 22,200 mark on the Nifty spot would be overcome. I'm sure a couple of you were surprised, especially since the Nifty had closed very, very close to that point because it was a Fibonacci level and the extension mark of 261.8 on the Fibonacci is a very meaningful level to watch. In my live mint column, in the very first paragraph itself of last week, I said that the banking and financial sector would be the sector to watch out for. And on Wednesday last week, guess what happened? The market nosedived, and it was the banking and finance sector which pulled the entire broader market down. Why? Because the weightage of banking and financial stocks is 35.26% in the Nifty 50 itself. So, whichever way these stocks go, the Nifty goes in that direction. And these stocks, as you can see on your screen, are broadly underperforming. The banking and financial sector, represented by the Bank Nifty, is telling you that it's been underperforming the broader base Nifty 50 since 20 weeks. The last 4 weeks, of course, you can call it a short-term kind of an outlook, but look at what's happened in a 12-week time frame, look at what's happened in a 20-week time frame, and you know what I'm talking about. If you were to even take a look at the interest rate sensitive stocks. Now, these are stocks that either depend very heavily on EMI based sales, or money is both a raw material and finished product for them because they borrow and they lend. So banks, NBFCs, heavily indebted companies, housing finance companies form this sector. And you will see that in the last 4 weeks, the Nifty has returned 1.04%, whereas the interest rate sensitive average returns was a negative of 0.8%. 12-week period, the Nifty was up 13.25%, whereas the interest rate sensitives were higher by 10.64%. Over a 20-week period, the Nifty gained 10.99%, but interest rate sensitive stocks were up only 8.96%. So this is a sector to watch out for. And the coming week is a special one because it is shorter by 2 trading sessions. Monday is a holiday and Friday is a holiday on account of Republic Day. It is also a monthly expiry of the January series, so the pull and push of rollovers and or squaring up of trades will also imbibe higher statistical beta or pure price volatility. Now, let's take a look at our usual metrics, and coming up on your screen is the weekly market roundup window. It tells you that the broader base Nifty 50 fell less than the Bank Nifty, and the rising US dollar index, the Dixie, exerted downward pressure on commodities. Bullion fell, natural gas fell. Of course, I had told you that Putin was likely to try and pull up gas and oil prices ahead of the Russian elections on 17th of March and play Santa. This was a post that I had put up on our Telegram channel on 10th of December. But I told you that these rallies would not last. And here you're seeing a good 22% decline in natural gas, and crude oil basically went up due to the Red Sea supply bottlenecks. The US dollar versus the rupee fell 0.06. And what you're seeing is that the rupee gained in value. So that cushioned the decline in our markets. The NSE market cap went up by almost 1/3 of a percentage points. That tells you that the broader markets were still optimistic. It was the headline index weighted stocks that were falling. The MWPL has reached a multi-quarter high. It finally closed above the 40% mark. But we'll come to that in the special segment on our in-house indicators. The US indices rose across the board, with the Nasdaq leading the charge and gaining the most. That provided tailwinds to our markets, and our technology sector stocks moved as well. Now, friends, I come to our in-house indicators, starting with market-wide position limits. Now, these are limits utilized by traders as a percentage of the limits allowed by SEBI. What you're seeing is that for the first time in this chart covering 20 weeks, we have seen MWPL reach 40.56%. As a matter of fact, this is the first time 40.56 is being seen in many, many months. So, buy and hold traders were basically increasing their exposure, and they were showing their eagerness to buy. This unfortunately results in higher volatility. You might ask why, because there are more buyers, but whenever there is any surprise, whenever positions have to get squared up by either side, the bull or the bear side, bigger positions will get squared up because the exposure is big. That leads to huge price movements, and therefore statistical beta, or pure price volatility, goes up. So from now on, get used to the idea that market will make big moves in prices as long as MWPL is above 40%. But being an expiry week, look at how every 4 weeks the MWPL crashes down. That's not anything to worry about. It's a routine expiry. I would like to see on Thursday as to what the MWPL falls to. If it falls to less than 29.63%, which is the post December expiry, I think the higher bottom theory will come into place. But we'll keep monitoring that. This is something that I update on my social media accounts every day, so please make it a point to connect with me there. Now, friends, I come to the stock and index futures turnover. This is a cumulative figure of 3 derivative series, that is January, February, and March. What you're seeing is that the turnover rose up. Not really a surprise. In the expiry week, what you see is traders squaring up their positions in the expiring month and reinitiating that position in the next month. So it results in dual turnover. So index futures turnover rose more than stock futures turnover, which means traders in the futures segment were taking a lower risk approach out there, at least for intraday basis. Now, friends, I come to the advanced decline ratio. This is the average of all 6 trading sessions last week. And what you're seeing is the Nifty fell by 1.47%, and the advanced decline ratio fell below 1 to 0.95. What it simply means is that over a 6-day time frame, the average number of gainers was 95 shares for every 100 losing stocks. Intraday traders were clearly nervous. They were not buying as much as they should, and therefore buying support was very mild. Now, this is a ratio that I update on my social media accounts every day. Please make it a point to connect with me. My contact coordinates come at the fag end of this video. Friends, let's see the prompt month or the near month futures basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Now, basis also erodes as expiry comes closer, which is what you're seeing. The basis has come down across the board in both the indices, and it will possibly come down even more. But what I would like to see is whether the basis inverts. Inversion means when the futures trade at a discount to spot. That indicates extreme amount of short selling pressurizing the prices to fall faster. As long as the basis is not inverted, bulls still have a chance of fighting back. So let's watch the basis carefully. This is again something that is updated on my social media accounts every single day. Friends, I now come to our in-house exclusive indicator, the impetus, which you've been enjoying for more than 3 years in a row now. Last week, I remember telling you that the Bank Nifty fell, the impetus rose marginally. The Nifty rose, but the impetus fell, which told you that the Nifty had risen last week. In my video, I had pointed out on poor impetus or poor momentum. That was validated by a decline in both the indices. But unfortunately for the bulls, the decline in both the indices has come on a sharp rise in impetus. That tells you that there was forceful selling. Now, most of this forceful selling can be attributed to Wednesday's decline in the market. That was a day when volatility or statistical beta really shot through the roof, and that had a trickle-down effect across the remaining 3 sessions as well. Now, if selling is going to be forceful, I think the bears are basically getting a little more aggressive. Ideally speaking, the price and the impetus on both the indices should be rising together to indicate a sustainable up move. But this is a figure that I update on my social media accounts every day. You won't get this anywhere on the internet, so do connect with me here as well. Now for our final exclusive in-house indicator, the lift weight thrust drag index, which is not available anywhere else, and you've been enjoying it for 2.5 years now. What you are seeing is the Nifty, represented by a blue line, has fallen 1.47%, but the lift weight thrust drag index from minus 0.38 has jumped to plus 0.46. What it basically tells me is that there is a good probability of short covering coming at lower levels. It's not really rocket science this time around. You don't have to use the LWTD indicator to guess why. It's the expiry week. Now, more often than not, shorts get squared up rather than get rolled over. People like to roll over their long positions more than short positions, which is why in the expiry week, short covering pulls prices higher. So the LWTD is indicating that short covering may be a high probability event, but do remember, like I've been pointing out in my live mint column, rallies triggered by short covering are temporary in nature. We want fresh buying, forceful fresh buying to come in if at all we are to expect a sustainable bull market. So let's keep our ears and eyes open wide. This is again an indicator that I update on my social media accounts. Do connect with me there. Friends, our in-house indicators done. I now come to the bond market, which saw the bond yields go up. That means bond prices fell. Why? Because our RBI governor, Mr. Shaktikanta Das, issued a statement in Davos that it was premature to expect electoral reasons for cutting interest rates in India. And similar voices were echoed by governors of various states of the US Federal Reserve. And The traders were expecting that rate cuts that are very highly anticipated in the calendar year 2024 may just get delayed, which is what triggered the sell off on Wednesday, which means cost of money was likely to stay elevated, and which is why the market reacted downwards with so much of great forceful selling. Now, does it mean that hopes of a rate cut are gone? Hey, I don't think so. Now, if you were to take a look at the four GILT funds that I recommended to you on 14th of December 2023, we are all still in the positive. And we've gained handsomely in terms of percentage change from the date of the recommendation, and year on year returns still continue to give you higher returns than the Indian 10-year benchmark bond yields. Why is the GILT fund return not compressing if the market is expecting that rate cuts will take a little longer? Because markets know that rate cuts are an ultimate reality, if not for anything else than for electoral compulsions alone. So the GILT fund NAVs are not really going down in a hurry. What do we do with these GILT funds? It is the first tranche that you've invested. We are going to probably invest more in GILT funds, of course, subject to certain conditions being met, or we jump back to our old horse, laddering of 10-year benchmark bonds, and as and when interest rates basically, bond yields basically jump significantly enough. So let's keep the powder dry and we'll take it as it comes. Friends, the bond market's done. I now come to the Bank Nifty, which basically surrendered 3.46%, as you can see on the daily chart on your screen. It fell on 4 out of 6 trading sessions last week. The price is below a month-long moving average, which itself is turning lower. So the short-term outlook on this index is slightly weak. Now note how the price has indicated a throw over or a false breakout above the bullish wedge on the Bank Nifty's daily chart. A throw over leads to a high probability of a throw under, which also occurred. And if at all there is substantial buying support coming in, or maybe short covering support coming in due to the expiry of the Bank Nifty January series, then you could see the price heading towards the 1 month moving average, which is currently poised at approximately 47,000 levels. So what we are seeing on the daily chart is high volatility, number one, with possibility of short covering coming to the rescue of the bulls in the near term till expiry itself. Now, let's take the weekly chart on your screen. The first thing that hits you, in addition to the throw over and throw under theory, of course, the first thing that strikes you is the big red power candle, the bearish power candle logged by the Bank Nifty last week. It has erased all the gains made in the last 6 candles. That was the relentless selling pressure that we saw on Wednesday last week. The 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, was tested but not breached. So the medium-term outlook as of now is still optimistic, but we need to stay above this average, and the average itself should continue to rise for the bulls to still have a fighting chance. We should ideally basically trade above the 46,000 or 46,100 levels for the bulls to get a fighting chance to stage a revival here again. If that happens, chances are we'll see short covering ahead of expiry and rollover of a bigger component of longs. Friends, in the week before last, this index was number 7 on the most volatile counters list based on statistical beta rankings that we maintain in-house. It rose 4 notches to number 3. That means volatility went up. That's challenging for retail traders. Last week, I advocated an estimated range between 48,875 on the upside and 46,550 on the downside. But thanks to the selling on Wednesday, the low made was 45,431. In the coming week, I expect an estimated range between 47,350 on the upside and 44,775 on the downside. A reminder again, being expiry week as well as a short week, I would suggest my traders, my viewers, trade light in the market. Also, please refer to our daily, weekly, and monthly free pivots that we update on our free Telegram channel. That's the only place where we update these pivot levels. My Telegram channel is the only place. It's a one-stop shop for all our research. My contact coordinates for that channel come at the fag end of this video. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell 1.47%. And like the Bank Nifty, it fell on 4 out of 6 trading sessions. The price has closed above its month-long moving average, which itself is more or less pointed upwards. So relatively compared with the Bank Nifty, I think the Nifty is in a far stronger situation. Note how there was a green color hammer made at the all-time high on Monday at the 22,124 level. That's a hanging man. Not a great thing to happen to bulls, because a hammer coming in at an all-time high implies that there was resistance to further upsides. And if it is followed by selling, which it was, Tuesday was a bearish day, but Wednesday was what you'd call slam dunk. There was huge, ferocious selling on Wednesday, and the Nifty really closed down with more than 400 points. So follow-up selling came in and the hanging man played its impact. But the month-long moving average is what you need to watch out for. And the point to note is that this selling has come very close to the 22,200 level that I have been mentioning since the last 2 or 3 weeks as a Fibonacci resistance level. Now turning to the weekly chart on your screen, what you're seeing is the highlighted pink shaded area, which marks the 22,200 odd level of the Fibonacci series. The other aspect that you can really hit your eye when at first you see the chart, when it meets your eye, is a bearish engulfing power candle. The bearish candle is completely overshadowing the previous week's bullish candle, and that is not a good thing to happen for the bulls. Now, what happens in follow-up action in the coming week will determine what happens to the Nifty. If at all there's expiry-related short covering and the price revives itself, good enough for the bulls in the absolute near term. But if it doesn't, then downside may just open up. What is the level to watch out here for? Now, do remember the Fibonacci level of 21,450 that I have been telling you since the last couple of weeks. If the Nifty 50 trades sustainably below the 21,450 mark, bulls could see further downsides opening up as well. The other thing to note on this chart is that the price is significantly higher than its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. Now, whenever the price difference between the 25-week exponential moving average and the closing of the Nifty is concerned, when the gap is this big, there is a mean reversion. Either the index consolidates sideways and the average catches up with the price before the price can rise, or the price will fall and try to meet the average before bouncing back again. But in either ways, there is bound to be some consolidation in the price. And do remember, all this is happening at 22,200 level, which is next to the Fibonacci 261.8% Fibonacci extension levels. So while the medium-term outlook is positive, the short-term outlook says that there is mean reversion, which is a possibility. So a pullback decline or maybe a sideways move to allow the moving average to catch up with the price can occur either ways. Now here again, If short covering comes because of expiry, fair and good, well and good. If rollovers of long positions are big enough and retail and smart money traders are lending their weight on the buy side, then the index can rise. But both ways, whether there's short covering and therefore price going up, or unwinding of long positions out of nervousness or panic, in both ways, statistical beta or pure price volatility is likely to go up. That is an inescapable fact, unfortunately. In the week before last, this index was number 17 on a most volatile counters list as per statistical beta rankings that we maintain in-house. It rose by 6 notches to number 11, which means the challenge level for the Nifty just went up. Last week, I estimated a range between 22,325 on the upside and 21,450 on the downside. Like the Bank Nifty itself, the low of the Nifty itself was violated thanks to the sell-off on Wednesday last week. In the coming week, I estimate a range between 22,050 on the upside and 21,125 on the downside. Please refer to our daily, weekly, and monthly pivot levels as well. They'll help you trade much better. They are available only on our free Telegram channel. Our contact coordinates are at the fag end of this video. Friends, I now come to the last bit of statistical analysis wherein I gauge the risk appetite of the retail trader by the turnover contributed by the 4 segments in the F&O space. The weekly chart on your screen tells you that the index futures contributed 0.03% more as compared to last week. It is indicated as a blue line. The stock futures contributed 0.17% as compared to the previous week. It is indicated as a red line. Do remember, futures take more by way of capital, span margins, mark-to-market margins, extreme loss margins, volatility and concentration margins, etc. And they are more volatile as compared to options. So the fact that more turnover has occurred in the futures segment is partly due to the rollover and also because of higher risk appetite. Now in the options segment, the least volatile and least capital intensive segment in the market is index options, which saw a huge decline in turnover contribution by 103 basis points, which is indicated as a green line. It is now at a multi-month low in terms of contribution. Where stock options are concerned, they contributed 0.83% more as compared to the prior week. It is indicated as a purple line. Now here it is at a period high. That tells you that the high MWPL that you saw in the prior in-house indicators segment itself, coupled with this chart, is indicating that there was very aggressive buying by big ticket buy and hold traders as well as retail intraday and swing traders. Now, this kind of excessive aggression can lead to higher beta or volatility. Now, unwinding or rollover of these positions holds the key to what happens in the coming 3 trading sessions of the week. So the short-term outlook remains that of high volatility. Friends, I now come to my trading strategy that I share with you every week. I continue the theta decay strategy in option writing in oil and gas with a possibility of linear future short trades at significantly higher levels, especially in oil in the FAR month series. Unfortunately, the FAR month series, which is April, is not very liquid, but whenever it gets liquid and I see a significant rise in the price, I might take a short call there. It's a strategic short sale, not for intraday trading purposes at all. The rallies in oil and gas are due to geopolitical reasons rather than demand expansion. High volatility may be seen in public sector units, especially public sector banks. So savvy traders who know how to handle risk and volatility may focus on these. But a caveat here, you'll really need to keep your stop losses in place. The interest rate cycle is likely to stay the course for a while, so bullion may see near term declines, but bigger falls are buy opportunities for long term buyers because inflation is not going away as easy as you think or you are being told. I once again draw your attention to the interest rate sensitive stocks. Look at how they have underperformed the broader markets. I've just given you the percentages over a 4, 12, and 20-week time frame. So here again, you have a lot of trading opportunities here, especially if the market is turning weak. Most of these counters might just underperform the segment. Hi friends, I reiterate what I just told you. Being a short, volatile week, I will keep my trading footprint light. And if at all there are any more updates, I would prefer to put them on our free Telegram channel. That's a one-stop shop where I put most all our research under one umbrella platform. Friends, I thank you for being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off, but not before reminding you to subscribe to my YouTube channel. In the comment segment, do let me know how this video helped you become a better trader and what else we can do to make your trading experience even more profitable. And hey, do share my video with friends and help us to reach out to even more smart and savvy traders like yourselves. I wish you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.